Hello everyone, my name is Hian, and today I will represent my reverse engineering about a paper that has been recently published by Ben David and others. The main focus of this research is about ETFs or exchange-traded funds. So many of you may not familiar with ETFs or exchange-traded funds, so I would like to demonstrate a little bit further about this. Before I will talk about stock index. So what is stock index? Stock indexes, for example, like the S&P 500 or the ASX 200. So the S&P 500 is the stock indexes that track the top 500 company in the US market, and the ASX 200, my more familiar with use, is the index for the top 200 Australian companies. And the stock indexes is normally calculated daily from the weighted average stock price. So it's just a number, and people cannot really invest in the stock index. But thanks for some financial innovation, the ETFs, exchange-traded funds, obviously, people now can invest in the stock index. For example, if you buy $10 of the ASX 200, which means that you buy $10 on the top 200 Australian companies. So instead of going to a brokers or going to an exchange and buy 200 stock individually, stock of Australian companies, you can now just buy one ETF shares. And because of its advantage, then more and more big players, more and more institutional players invest in these instruments, So which leads us to the main motivation, the main puzzle that this research would like to investigate. So the question is it possible that any demand-supply shock in the ETF market can somehow transfer to the volatility in the underlying stock price that the ETF tracks? So the main idea of this research is about the different type of shock in the stock price. The first is the fundamental stock. For example, if the price of the stock changes from a new fundamental information, like the company's scandals or a strong positive outlook of a company profit in the near future, then the price of the stock may change permanently, or at least for a long time, until the new information, the new fundamental information came to the market. Another kind of shock in the price is somehow transmitted from the supply and demand shock in the ETFs markets. So maybe when there's more demand in the ETFs, the price of the ETFs increase, which somehow maybe increase the price of the individual stock in its portfolio. So this kind of shock may somehow cause a price revert or come back to the original level before the shock. And furthermore, another idea in this research is that because of the advantages, because of how the ETFs works, so then it might somehow more attractive to short-term investor. So more and more activity of short-term investor can somehow cause the volatility of the individual stock price to change to another level. So the data of this research come from some reliable sources and also some tools in here. Anyway, the empirical literature strength about the effect of ETF's ownership have on the individual stock in this portfolio has been studied, and the main conclusion is that there is a significant and positive relationship between the ETF's ownership and the stock level of stock volatility, which is also one conclusion of this article. But furthermore, this article has linked the ETF ownership to the activity of investor with high turnover or high frequency investor. Moreover, if the arbitrage trading activity is strong in the market, then the effects of the ETF's ownership have on the level of stock volatility is stronger. So it is this finding is somehow important because the level of stock volatility changes by ETF ownership is somehow represent noise in the stock price and not the price improvement. So maybe opportunity for hedging, and maybe caution for investor when there's a higher arbitrage activity in the market and the stock price volatility increase. Another new finding in this article is that when we control for the ETF flows or when we control for the changes in the ETF ownership, then the ETFs the result is that the ETF ownership is somehow can be considered as a new source of systematic risk. So nowadays, expected return require a risk premium for the ETF's ownership rather than the rising demand of the ETF itself. This literature contributes to three strands of empirical literatures. The first one I have mentioned before is about the effect of ETF ownership have on the stock price volatility. Another contribute is to the role of institutional investor have on non-fundamental demand shock that inbound into asset price. Another contribution is to the effect of derivatives on the quality of the underlying security price, because the ETFs have some familiar feature to the future instrument. The last part is other consideration. So far this article is only focused on the relationship between stocks short-term or high-frequency trader have on the ETF ownership, and somehow indirectly linked to the volatility in the stock price. So maybe in future work, people can focus on other type of traders. Furthermore, this evidence on the role of arbitrage have is indirectly. So maybe in future work, people can have some method or some findings that somehow directly link the arbitrage activities to the stock price volatility in the ETF markets. And one more thing is about the ETF ownership changes. They only pick the changes in ETF ownership on some occasional particular occasion. For example, when index switching or index reconstitution. So because of that, the changes in ETF ownership and its effect of ETF ownership on stock volatility cannot somehow represent the full sample of the ETF ownership have on the stock volatility. And this is the end of my representation. Thank you.